Welcome everyone to the MGA Brexit Forum. I'm Marco Del Carlo, CEO of Capacity Place and a director at the MGA. Joining me today are Chris Croft. Chris is Chief Executive of Liiba. Chris has spoken extensively on quite a wide range of subjects, Brexit being one of them. And he's going to offer us the broker's position as to, and as well, where the majority of Liiba members are with their planning. Also joining us is Harris Khan. Harris is a representative from Lloyds Brussels, who I'm sure is fielding a lot of questions from Lloyds cover holders right now, and will share the Lloyds perspective. Then Helen Dalziel, that's how you pronounce her surname. We've all gotten it wrong, so just for future, that for all those people that get to know her, it's DL. She's a senior legal and market services executive at the IUA. And Helen's going to inform us as to where the non-Lloyd markets are at, and hopefully will give us some greater indication in terms of impacts on changes to MGA arrangements for her set of members. Last, we have Howard Jones. Howard is a tax partner at PKF Littlejohn who specializes in insurance. Howard advises on a wide range of tax matters related to insurance operations for intermediaries, Lloyd syndicates, and companies. And Howard spent 10 years at Aon as Director of Tax, and so he's going to share his perspectives. He's going to share his insights from a tax perspective. Ben, do you want to switch to the slides? So during this webinar, your volumes have been muted to reduce background noise so everybody can hear. If you have a question, there's a little chat button there on the bottom. You can just tap into that and ask a question, particularly as all of the speakers go through. And the forum is being recorded and will be available at the MGA website for future. Ben, did I miss anything there? Oh, I guess the last item on there, feedback forms. So I guess we'll send out feedback forms to everyone just to ask, what did you think of this? The format for today's forum is I'm just going to start off by sharing the results of a Brexit survey that we conducted among MGA members back in March. Then each speaker will speak for 10 minutes, giving a presentation, and at the end we'll then open it up and have a Q&A session for each of the speakers. I also know that there's a number of people that are also attending this call that have their own experience, either UK MGAs that are setting up in Europe, or there's some European service providers, I think, on the call as well. I'd absolutely welcome them to join in, add their contribution, certainly at the end, because we'd love to hear from them. Purpose of this forum basically is to try to uncover, discover options that are available, particularly for UK MGAs, as they address all the problems of setting up in Europe or being able to continue to trade in Europe. I think that's about it. Do you want to, Ben, yeah, there we go. So MGA Brexit survey headlines. So we issued a survey back in March and to all the MGA members. I think about a third of our membership responded. And it was interesting. What came back out of the survey results was as follows. I mean, there's a number of points here that Ben has up. It's up on the slides, but 74% responded that they had written business in EU domicile, involving EU domiciled insureds or cedents already. So there's already a strong representation, if you will. 63% advised that they're currently underwriting. Going forward, 42% are continuing to plan to underwrite post-Brexit, and then the solutions that I think everybody is looking at around that varied massively. What came back was some MGAs were already, up, running, set up. They've done that. Some were in the process of just exploring options. Some were waiting and seeing until everything settled, all the dust settled, because there seems to be so many changes in regulation, legislation. Some are just waiting to find out, follow the leaders, if you will, to figure out who's got the best solution, and then, fast follow from there. Other ones have just resigned themselves to the fact that says, look, we just don't have, we're not going to, we've got, our European footprint is far too small. We're just going to exit from it. So it was a real mix in terms of responses that came back from our membership. Hopefully today will provide greater insight for everyone to be able to understand what the issues, the options are, particularly in a fast-moving world. So with that, I'll turn it over to Chris, who will give us the viewpoint from Liiba. Chris.
Okay, I just fortunately remembered to unmute. Brexit for insurance brokers is a difficult conundrum, and especially so for Liiba members, and indeed, I would presume for many of the MGAs who are involved in the sorts of insurance that politicians and regulators don't have in mind when they're drawing up laws and regulations and directives. Because certainly in the EU, we find that they focus almost exclusively on domestically traded motor and home insurance. And the idea that some insurance is so complex that to access interested capacity, you may have to look to another country for interested insurers is an anathema to most EU regulators. And that is how we come to be blessed with inadequacies such as the Insurance Distribution Directive, which is the root of pretty much all of our challenges when it comes to Brexit. In part, IDD is an accident of history. It was finalised in February 2016, so its deeply unsatisfactory treatment of international trade was not really perceived to be an issue then. IDD's fallacies really come in two parts. Firstly, it's entirely silent on the question of where an activity takes place for regulatory purposes, which is actually quite a crucial definition to have. And EU regulators themselves have an unhelpful interpretation of this, as I'll come to in a moment. And when you take that definition and combine it with Article 16, it becomes quite problematic. Article 16, that's always good to get some proper legalese out in a presentation like this, but Article 16 says, Member States shall ensure that, when using the services of insurance, reinsurance or ancillary insurance intermediaries, insurance and reinsurance undertakings and intermediaries use the insurance and reinsurance distribution services only of registered insurance and reinsurance intermediaries or ancillary insurance intermediaries, including those referred to in Article 1.3. Trust you all got that. But what in essence that means is if someone's delivering a regulated service in the EU, they need to be registered in the EU, and other insurance entities mustn't use the services of an unauthorised entity, which in and of itself is perfectly sensible. But when you get the cases we do with pretty much every EU regulator, that they insist that if you're dealing with a contract where both the policyholder and the risk are located in the EU, then regardless of where you sit geographically or where you sit in an international distribution chain, if you're doing something that fits within the definition of insurance distribution in IDD, you're delivering that service in the EU when you do it, then you have a problem. But we'll come on to that in a moment. I think we should just finish off the story and return to February 2016 and finish the story of why we are where we are. So IDD's predecessor, the Insurance Mediation Directive, IMD, had similar provisions. It was Article 3.6 in that case. But two other things were also true. Our FCA has a very different interpretation of where activity takes place. So it will tell you that if you're sat in London talking to an underwriter, then you're delivering a distribution service in the UK when you do that, and only the UK, regardless of who the client is or where the risk is located. And when FCA transposed IMR into its handbook, it added an exclusion from Article 3.6 for dealing with third country intermediaries or overseas intermediaries, because it's entitled to do that because it was a minimum harmonisation directive, as IDD is. So it's creating a base level of regulation which individual regulators are entitled to add to. So that exclusion that the FCA introduced protected international wholesale broking. So in February 2016, safe in the knowledge that the FCA would do the same thing with IDD as it done with IMD, no one was wasting lobbying effort on trying to clarify this. It was only in the following June that it all absolutely became an issue. So cue 2.5 years of back and forth, rather tentative diplomacy on the issue between us via our European Federation BPAR and the EU supervisory body EIOPA. And I say tentative because our main rule of thumb at BPAR, and when we enter into conversations with both the Commission and EIOPA is if you can emerge from the meeting without the wrong answer, then that's a win. So you are always quite cautious because often clarity is not the clarity you want. I'd never previously been to Frankfurt before I started this job. I now know Frankfurt rather well, and indeed I'm missing it under lockdown. EIOPA occupies the top floor of, by some distance, the flashiest building in Frankfurt, which is what you would expect from unaccountable taxpayer funded European institutions. Anyway, moving on. In ways that will have to remain a secret until the full history of Brexit is written, EIOPA's attitude to internationally traded insurance ebbed and flows, and there were drafts produced that would have had the effect of cutting the EU off from the rest of the global insurance market. But in the end, a modicum of sense prevailed, and in February 2019, EIOPA published some recommendations clarifying some details around Insurance Distribution Directive. The ninth of these was the only one that applies to distribution, and it says that the scope of IDD is limited to contracts where there is an EU policyholder, a carefully chosen word, with an EU risk. Actually, what the recommendation says is EU policyholder and EU risk, but every EU regulator I've spoken to is clear that it is what they call a cumulative and. That's obviously not a thing, but since it helps, we'll go with it. So with the scope set to it having to be contracts where both policyholder and risk are in the EU, it then reiterates that any entity delivering a distribution service on such a contract is delivering it in the EU and needs to be authorised to do that. It's just what IDD says anyway. So that sets the parameters of our challenge. And in the absence of any wider market access provisions in a future trade agreement between EU and UK, and more on that shortly, we have a double-edged conundrum to solve. If, as a broker, you wish to continue to service EU policyholders with EU risks. So you need to have an entity that is EU authorised to meet the dictum of EIOPA, but if it's going to do that servicing by introducing business in London, it simultaneously needs to be authorised by FCA. And thus the birth of the reverse branch or back branch model came. It's worth pointing out that it's a limited number of, or limited cross-section of the Liiba membership that's facing this challenge. Probably at most about 15% of London market business emanates from the EU. Many of our members solely bring business from other parts of the world and are thus relatively unaffected directly by Brexit. But those that are have spent the time since June 2016 setting up these reverse branches. They've created a subsidiary organisation somewhere in the EU and applied to the local regulator for authorisation to satisfy EIOPA. And then that subsidiary has created a branch in London that can be authorised by FCA, and all are currently registered to be part of the FCA's temporary permissions regime when it opens on January the 1st, 2021. This has not been done without difficulty, confusion and cost, but at least we have a route to market, and route to market has been found. And as I said, there were times when it seemed even this would be blocked. So there was a draft of the EIOPA recommendations that made the point that the third country branch regime is designed to deliver services into the third country and not back into the EU, and so you wouldn't be able to use that method either. But unfortunately, that draft never saw the actual light of day. So in general, how our firms have chosen where they locate their new EU subsidiary is to start with looking at where they already had an office, because that avoided establishment costs. And that explains why there are a few who've chosen Paris, because they would argue they were already the victims of France's extraordinary employment laws. But where people have had a free choice, two venues have proved popular. Dublin, despite mixed views on the attitude of the Central Bank of Ireland as a regulator, and Belgium, because its government, when it last had one, proactively courted our members and plied them with sizable amounts of their excellent beer in their very opulent embassy. So we have solutions in place that were devised as contingency plans for a no-deal Brexit, and will a deal make any difference? I don't want to be unduly negative or to use unnecessarily provocative language, but I would say not a cat and hell's chance. Market access for financial services is being discussed almost exclusively in the context of equivalence, And here, in its third failing, IDD excels again. Because whilst many EU financial services directives have whole sections devoted to equivalence, how it might be judged and what access rights third country firms would get if it were granted, IDD just doesn't have any of that. There's no equivalence framework in IDD at all. So you can't have equivalence for insurance distribution, and if that's going to be the approach to market access, we'll just get left out. Which is in some ways unsurprising, going back to the point I made at the beginning, because if all you have in mind when you're drafting a directive is domestic motor and home insurance, why would you make provision to support international trade? So Brexit for brokers means back branching, deal or no deal. And as acting under delegated authority is seen as a distribution activity in the eyes of IDD and EIOPA, it is basically the same model for the noble MGA as well. And I will stop there. Thank you very much.
Thanks, Chris. Hugely informative. Yeah, and I guess from an intermediary perspective, a wholesale broker and MGA are sort of treated very similarly from an IDD perspective. The MGA also, I forgot to mention, also had an involvement with setting up a mandated underwriter regime in Brussels or in Belgium. Yeah. And I think that it's a similar sort of approach, which is, you know, Belgium has been courting and been more open to establishing MGA, or more open to looking at different models in terms of attracting UK MGA business in there.
Yeah, there was up until then no concept of delegated authority in Belgian law, which was kind of came as a bit of a surprise to the many MGAs who were already located.
Yeah, we had. I don't want to talk too much because I don't want to. I know everyone else has a chance to talk, but what baffles me is when it comes down to intermediary regulation, it's all different in every EU jurisdiction and in the UK. The MGA regulation in terms of delegated authority just doesn't exist in any European country, as best we can see it. Every country is different in terms of how they do it, so it poses a particular problem for MGAs that is probably different than wholesale brokers. Hopefully a few of the people are going to pick up on that later on as we go through. But hugely informative, Chris. Thank you very much. Can I now turn over to Harris to give us what you were seeing from a Lloyd's perspective?
Sure. Thank you, Marco. I think Chris set the scene quite well there, and it kind of flows nicely onto what Lloyd's have done and what Lloyd's Insurance Company in Brussels has done in regards to some of the points that Chris has already raised around the IDD and the kind of impacts of EIOPA's recommendations. So if I could go on to the next slide, please, Ben. So as Chris kind of already highlighted, one of the early recommendations within the recommendations released by EIOPA in February 2019 was recommendation 9. And as Chris said, that there was a cumulative test within that recommendation around being an EU risk and an EU insured or policyholder. So this Venn diagram kind of illustrates the kind of business that Lloyd's Insurance Company are interested in terms of making sure falls within the IDD and then therefore done by an EU authorised entity. So where you have an EU or EU policyholder and an EU risk, this is what Lloyd's Brussels is deeming as impacted business, as in impacted by EIOPA recommendation 9. And therefore falls within the IDD and therefore needs to be conducted by an EU authorised entity. So what do these changes mean? So what Lloyd's Brussels have done is they've developed a new endorsement that goes attached to their coverholder appointment agreements. This is numbered LBS 0082. And what that effectively does within section 9 of the contract limits the ability of that coverholder that's been appointed to write insurances where there's an EU policyholder and an EU risk. And then essentially that is coming into effect from the 1st of October 2020. So what do these changes mean for your business? So non-impacted business, so where you've got either one or the other, they can still be done on the CAA. Again, there's still considerations to be taken as to whether or not, as a UK entity, can you solicit EU policyholders? Can you do EU risk from the UK? Those considerations still apply, but for the purposes of recommendation 9 and the work that Lloyd's Brussels are doing, that can continue with your current CAA in place. And then those that have been impacted by recommendation 9, so where you have businesses where you're doing property insurance, for French insureds in France, and that will most likely be impacted by recommendation 9, and you would need to essentially limit what your current CAA is currently doing with this LBS 0082 agreement and transfer that across to an EU authorised entity. So if we go to the next slide, what that essentially means is something that Chris has already talked about, and it's kind of setting up an EU branch or back branching or reverse branching. So what's the steps if you're a UK cover holder and if you've already got your EU cover holder or MGA established? So one of the first deadlines that we had was the 1st of July 2020, so that elapsed last week. This was the deadline imposed by Brussels to say that we need your, if you're a UK authorised cover holder, we need your CAA that you have with Lloyds Brussels to be endorsed with this LBS 0082, restricting your ability to do recommendation 9 business. That essentially goes on to the 1st of October 2020, and that's where essentially any new and renewing business written by the UK needs to transfer across and needs to happen via an EU authorised entity or the UK branch thereof. And then lastly, it's the 1st of January 2021. So that's the supposed date after the transition period is ended. Obviously, we're not in a position at this moment to know if we're going to end that transition period with a deal or it's going to crash out with a no deal. So in that scenario, we expect any existing business already written by UK cover holders as impacted by recommendation 9 to transfer across to an EU authorised entity for administration and services. And then from a UK cover holder, EU cover holder perspective, or if you've got a UK domiciled branch of that EU entity, you need to have a CAA in place with Lloyds Brussels to write that impacted business. It's full scope of EU and EA business, and that needs to be in place by the 1st of October 2020. So that's the current deadlines and steps that cover holders and EU cover holders are expected to be taking for recommendation 9 business. So if we move on to the next slide then, what are the current key steps that Lloyds Brussels are currently taking? So as the deadline for endorsements has already elapsed, what Lloyds Brussels did was send out a schedule of all the CAAs that the managing agents hold with you guys, and has engaged with them and asked them to complete the schedule and say, look, where you've got a CAA, has that been endorsed by LBS 0082? And then to provide that back to us completed to say that this endorsement's been done. We've uploaded that with the help of your brokers to DXC's or Exchanging's IMR database, and we're comfortable that when the 1st of October comes, this CAA will not be able to write recommendation 9 business. So the deadline passed last week, so the next steps for Lloyds Brussels is to start engaging with those managing agents to kind of go through each of their scheduled kind of inputs to make sure that they've endorsed them correctly and that your current contracts with your managing agents are in line with what Lloyds Brussels is currently expecting. Then the second step is to go in and validate all of those endorsements that have been uploaded via your brokers and managing agents to say that, yes, Lloyds Brussels can see that for CAA X, that this LBS 0082 endorsement has been applied and it's limiting their ability to write recommendation 9 business from the 1st of October. And then the third is to host a webinar with UK cover holders. So Brussels are kind of looking to engage and kind of say, well, what would be the best time? So looking at potentially August, September. We know that time for insurance is generally quite a low period, so we're just trying to make sure that we have the appropriate viewership to make sure that Lloyds Brussels can engage with all the cover holders to make sure that they are in line and are doing business expected as per recommendation 9 and ITD. So where you can find more information about the changes we're implementing, I had made this blue, apologies if it's not coming through on the screen properly, but it is hyperlinked. So we've got a dedicated page on lloydsbrussels.com website around recommendation 9. We'll be updating that with additional FAQs that we've been receiving from brokers and from cover holders, and we'll be using that to kind of update all the information in regards to the recommendation 9 process so far. Who you can contact, so Jack Knappen is the Lloyds Brussels DA manager. I've got his contact details there, so if you have any queries, you need any responses in regards to your business that's particular, to your scenario, please get in touch. I've also got my contact details, so you can happily reach out to myself as well. And we also have a centralised mailbox that we're dealing with all the Lloyds Recommendation 9 and all Lloyds Brussels DA business as well. And it's a mouthful, but it's Lloyds Brussels delegated authorities or delegated authority at lloyds.com as well. So, if you do have any particular scenarios that you might not want to discuss at the end of this forum as part of the Q&A, please do get in touch with one of those contact emails. I'll be happy to discuss those. Obviously, fully aware that the deadline has passed, so if you do have any concerns as to how your business might be impacted by some of the Recommendation 9 work, please do get us in touch as well. Sidestepping and moving on to the next slide, another element of what's been a big process in regards to what Brexit has triggered is the kind of Part 7 transfer. I won't go into the details of what the transfer is. Obviously, I'm sure a lot of you know that there's a legal requirement where the insurer is changing. There's a process, a court process that needs to be followed to allow that business to be transferred from one insurer to another. So in this instance, it would be Lloyds Underwriters transferring across to Lloyds Insurance Company in Brussels. So the effective date of the transfer is the October 29th, 2020. Following, there'll be some court hearings in the UK High Court that Lloyds will be attending. So what are the risks that are in scope within that? So EEA risks relating to EEA risks and where a risk has been issued or held by an EEA policyholder. So the look-back period that has been kind of developed with Lloyds and the managing agents is from 1993 all the way to April 12th, 2019. And then for reinsurance business, the end of October 2020. So the Part 7 transfer process will not include any risks or insurances bound by Lloyds Brussels since it became operational. So it only impacts business for Lloyds syndicates written prior to the April 12th, 2019. So if we go to the next slide, so some of the key impacts that it's having or will have on cover holders will be that there'll be a kind of need to notify your policyholders. So because the insurer on those policies that have been written is transferring from Lloyds Underwriters to Lloyds Insurance Company, there'll be a period of notifying those policyholders. So cover holders are being formally engaged this month in regards to the transfer of the process, and this will give you the ability to kind of object and attend the court hearing. We'll also provide Lloyds with, we're asking cover holders to provide, I think there should have been some engagement, there's been some engagement over the last month, and webinars held with country managers of Lloyds with those specific countries in regards to the Part 7 transfer process. So as part of that, we're asking Lloyds cover holders to provide contact details of individuals or teams within your organisation that Lloyds can use as part of its central multilingual transfer hub that it's created. So where they receive inquiries from policyholders, they know who to contact within a particular managing agent or cover holder. So there is an email, so if you've not done that, there's a notification email that you can send, say these are the details within my organisation. If you do receive any queries in regards to Part 7, they can be directed to this person or this team. And then there's also an obligation that policyholders, if they have a client-facing website, to publish a message in regards to Part 7. So essentially that will be from the 15th of June, so it should be live already, running it to at least the 31st of October, which will then eventually be directing those policyholders and clients that you have to the Lloyds Brussels microsite in regards to the Brexit transfer that it's conducting. There's also going to be some limits in regards to premium and claims. Cover holders need to know what the transferring status of all binders are to enable the servicing of those risks and binders as part of Part 7 transfer process. One of the parts of the process is Lloyds engage with managing agents to get a return of all their Part 7 business, open market, line split, delegated authorities, binders business as well. And we've conducted and compiled a master list. So that master list will be shared back with managing agents so that they can share with the individual cover holders that they've written with to say that these are the parts of the policy that are been identified, and you need to know which within those is going to be transferring or not transferring, or it's a bit of a mix of both EEA and non-EEA risks. After the transfer, cover holders will likely to submit a monthly Part 7 bordereau and transaction premiums and claims relating to the Part 7 business. So where you've got open claims or where there's premiums required, there will be a process in regards to providing monthly bordereau for that. Cover holders must identify all transactions relating to Part 7 transferring policies, utilising the master list and segmentation logic. Again, there'll be loads of communication coming from the Part 7 process for cover holders, managing agents, brokers and TPAs in regards to what's expected, what the segmentation logic is, and what the master list contains as well. And the handling of Part 7 claims will likely follow Lloyds Brussels' current BAU process. If you currently do business with Lloyds Brussels, the claims handling process will follow the same process. Moving on to the next slide, some additional considerations around complaint handling. So there'll be further guidance released in regards to complaint handling, but it is envisaged that if you have any open complaints related to EEA cover holders or policy holders, that you kind of aim to resolve those as soon as possible prior to the transfer to avoid any kind of operational or administrative issues that you might have with that complaint transferring across. Before the transfer date, there may be Lloyds Brussels may be engaging with you to ensure that you meet their kind of complaint handling process and procedures. All complaints and management activity, including notifications and resolution of the Part 7 transfer business, will follow the existing BAU Lloyds Brussels complaint process and guidance. So if you currently do hold a CAA with Lloyds Brussels, it will follow the same process that you're currently adopting. And then an additional consideration is around asset transfers for the loss funds. So as far as I'm aware, this process is still being developed and defined. Likely that the loss fund to pay for claims on Part 7 transferred business will be owned by Lloyds Brussels. The ownership of any funds already held by cover holders for this business will be transferred from syndicates to Lloyds Brussels. So that will have obviously wide-ranging impacts for you guys. Expect communication from managing agents in regards to if you have a loss fund with their syndicates. And then obviously there'll be changes to banking arrangements that you currently have with those loss funds as well. So change of the name of the account, etc. might be, or setting up new accounts. So there'll be a whole host of new information. So if we move on to the next slide, Ben, just kind of what you can expect in terms of the information coming or in regards to the Part 7 process, because it's a highly complex area, and I'm sure lots of you have had questions. I've had questions from you guys as to what you should be expected. So version 4 design document, which provides an overview of the Part 7 solution and guidance on managing agents, brokers and cover holders. That will be issued at the end of this week to the market and participants. So the aim is to get that out by the 10th of July. The Part 7 project is to issue a cover holder guide by the end of July as well. So that's currently being drafted and it's going through the governance process of getting signed off by the relevant associations and governance process that the Part 7 process follows. And that will be issued to cover holders by the end of July. As I've mentioned previously already, the Lloyds has developed a microsite for participants and policyholders, and it's got a wealth of documentation and information around the Part 7 process as well, and that can be found at lloyds.com/Brexit-transfer, I think it is. And for further information on who to contact, there is a dedicated Part 7 mailbox as well. So that mailbox is used to compile FAQs, which will be attached to the cover holder guide coming out at the end of the month, and it's kind of used to kind of feed additional information, inquiries that you might have that are specific to your business. Is kind of advised that you go through that process as well. So that's Part 7 at lloyds.com for any additional information that you require that you might feel impacts your business relating to Part 7 as well. So that's the end for me. Hopefully if you've got any questions, I can answer them at the end of the session. I'll be passing it on to Helen now as well.
So I was just going to say, just before Helen speaks, thank you very much. Yeah, so there's, if there's questions, either based on Chris's or on Harris's, by all means, please add them to the chat. Going through that, hugely informative. My heart sank in terms of the amount of additional work that's actually needed. And I know we're going to have some things that are very specific questions. I'd suggest taking those offline, but if they're of a general nature that's going to impact a number of MGA members, by all means, please ask. Helen, over to you.
Thank you. So Ben, can I have the next slide, please? And the next one. Thank you. So our members currently stand at 63. just some of the logos there. Next slide, please, Ben. So it represents the vast majority of company market business written in London. We also have affiliate members and associate members. Next slide, Ben. So this is a graphic illustration of the parent companies of our members, and actually very few parent companies are in the UK. The majority are either outside or in the EU or more international. Next slide, please, Ben. So many of our members are incoming EEA firms. So as things stand, Treasury and the regulators have put in place a temporary permissions regime that will enable any incoming EEA firms to continue to trade and write business in the UK while their UK authorisation is being considered by the regulators. So this actually prevents disruption for the incoming written business in the UK. Next slide, please, Ben. So it's expected that this regime will be in place for 3 years. Pretty much all of our members that expect to continue to trade in the UK have already submitted their application for full authorisation. This was done at the beginning of 2018. This was when we were initially going to be potentially leaving the EU in 2019. The statutory time that the regulator has to consider an application is 12 months for insurers and reinsurers. So this is why the regulators demanded that all firms get these applications in and their contingency plans up and running for that particular time. Next slide, please, Ben. So some of our members have advised that Brexit will not affect their portfolio because they don't write any EU business. As I said, the application's already in, being considered by the regulator. The regulator advised us last week that their decisions will depend on any equivalence agreement that is reached by the UK with the EU as to what that authorisation will look like. But that temporary permissions regime is going to be in place for 3 years. And there is also a kind of leeway of 15 months once the once the transition period ends for those incoming firms in respect of their reporting requirements. So it looks like as of 11 p.m. 31st December, anyone that has any business written with an incoming EU firm doesn't need to worry because that business will continue as normal. Next slide, please, Ben. So we've been working very hard to try and get the message across in addition to the issues highlighted by Chris in respect of there is no third country regime under the IDD. There are some equivalence rules under Solvency II, but whether there will be an equivalence decision or equivalence agreement reached as part of any agreement is anyone's call really at the moment. So in order to minimise any disruption, those members that didn't have an EU framework already set up have already put in place an EU framework. And most of our members were probably already writing the EU business in with that EU authorised framework. So over the last 18 months or so, our members have advised us that they have been making the transition at renewal from the UK entity to the EU authorised entity. And the Delegated Authority Committee has said that they were working very hard towards 411 this year to try to start getting in place all the binding authority agreements with the UK authorised entity. We've been responding to lots of consultations in respect to Brexit. There are a lot of other implications involving tax, IPT, that we are maintaining an overview on and inputting where necessary. it's difficult for us to actually tell you each individual member's own framework and what their processes are, because there are potentially 63 different answers. So it's not just the same process as it would be for Lloyds. We're also liaising with other market bodies that have very strong lobbying functions to ensure that the insurance message doesn't get lost amid the banking and investment side. Next slide, please, Ben. So when the referendum happened, as Lloyds are doing, many of our members that are transferring the EU part of their portfolio will be doing so via a Part 7 transfer. And we identified that there is going to be possibly continuity issues with regards to contracts at the point of Brexit. So the IUA in its clauses committee wrote some model wordings that enabled two different entities to actually be able to be on the policy to bridge that transition gap. So if in the event of Brexit or leaving the EU, the UK entity can no longer write business, that clause will activate, and the carrier will then be the European entity. So that was a kind of a backstop to ensure that there was contract continuity. These were published, I think, in 2017, 2018. So they've been available for the market to use for the last couple of years. Next slide, please, Ben. We also have been working with Treasury in respect of the statutory instruments that the UK government is drafting to implement EU legislation and making sure that it works for the industry. And we are also working very hard outside of the EU on other international agreements where we're trying to strengthen some ties and open up some trade barriers to make sure that the business that London can write continues to be able to grow. It's actually quite nice to talk about Brexit for a change from the last 4 months. I know that we were all rather overwhelmed by it initially. Certainly regulators and government bodies are raising this issue because it is now looming on the horizon and approaching us quite rapidly. So thank you very much, and I will now hand over to Howard.
Sorry, just before Howard goes on, Helen, so the key area that I think our members are interested in really is the delegated authority bit, and I think you did a great job setting the context for that. Who is actually looking at the delegated authority aspect of that going forward? Like Lloyds is already there, they're already moving forward. When it comes down to your members, it seems to be that they're, if I would say, like a year behind on that front, and so I think there'll be a lot of members that we have that are more like, what's the IUA doing insofar as this is concerned? I appreciate that there's a backdrop that's there. Are there people within the IUA that are taking that forward?
So as we've got 63 different members, there are 63 different processes. This is something that is discussed at the Delegated Authority Committee that the IUA runs. It's certainly been something that we've been discussing on the agenda, but it will be down to each individual member and their own framework and what their portfolio is as to what their process will be. Some have already made that transition to the EU entity, and they have asked for new binding agreements to be signed with that EU entity for the EU risks. Others are still in the process of looking through and identifying which of their delegated authority facilities are affected, and looking to either endorse the existing delegated authority or issue a new one to their cover holders. It's difficult for us because there is not just one single answer. I'm more than happy as the IUA to take any individual queries and pass them on to the relevant members, but it's just because it's such a variety of different circumstances, different frameworks, and everyone's at it for a different point. It's really difficult for me to answer that simply. Okay,
thank you, Helen. All right, turn it over to Howard. Howard, over to you on structuring and tax.
Thanks, Marco. Just a quick bit of background in terms of Brexit operations. like many people, I started back in August, September of 2016 working with carriers, primarily about determining the European operations, what was to be transferred, especially with the Part 7 transfers that are involved with them, considering that the usual Part 7 transfer would take between 9 months and 2 years, but I have known it taken up to 5 years. So it was important to start early. Early 2018, started to work with more insurance intermediaries, and I continue to do so today. There are still intermediaries that are setting up businesses in Europe with the back branching structure. So today I'm going to have a look at predominantly that back branching structure and really to see how tax affects that. If I could have the next diagram, please. Excuse me, thank you. The challenges faced are significant because the regulatory situation is it's known, it's unknown. As the UK becomes a third country and trying to balance that with a number of other matters. Also helping clients with ensure that they can provide confidence to their clients as well as the underwriters that they are working with. Countries also being looked at for their own local EU expertise, which is not amply abundant. And after a lot of people have been into those countries, there is not a lot of expertise left. The other aspect that a lot of companies have had to be careful about is the management of time and cost in terms of setting up this operation, and therefore how should it be structured. Next slide, please. So what happened? Most cases set up an EU entity in their own chosen jurisdiction for various reasons, and trying to manage the interaction between the regulations and the resources that individual companies, groups have. Coming out from that, there are a number of structural taxes that need to be looked at. The solution was obviously in terms of establishing the UK branch, being prepared for the Lloyds registration, and the FCA through the temporary permissions regime. But coming out of that are a load of operational taxes that one has to look at. And then we have to look at what I like to term as structural dynamics. It's always nice to have dynamics in a tax presentation. And these are the inherent challenges that are taking place in terms of your clients, where your capacity is coming from, in terms of the market itself, changes that are taking place. And then we come to the Donald Rumsfeld changes, which are we know the unknowns, and it's the unknown unknowns that we just can't plan for at the moment. Putting that one aside, we also have an increase in tax in terms of anti-avoidance. We've had the OECD, the EU heavily involved with it, the UK government as well, and there's increasing cooperation between governments on this. So having looked at your structure, you therefore need to try and finesse it in a way that works for you. Could I have the next slide, please? This was a little chart I put together in terms of where I saw the insurers going in the first column on the left-hand side, and that's extracted from various press and press releases that have taken place. The next two columns are from the Lloyds Market Directory. So there's a combination there between both those companies that had existing operations prior to Brexit and were either authorised or were registered with Lloyds. And there are a number of companies there now that have set up an operation overseas in order to cope with Brexit and to be able to be in a position to write business going forward. Next slide, please. So I thought I'd have a look at a simple structure, back branching, and that way you can actually spot some of the tax issues with it. Milner and Sons, I just put some summary figures in there, 45 million of turnover, 50 million PBT, net assets of 5 million. A third of its business is in Europe, and therefore it decides it has to do something about it. So it sets up a company, Van Dyke BV, and it eventually manages to find local talent and employ Mr. Allison. They later set up a branch in the UK. Croft valuations have certified that the group is worth about 150 million. Next slide, please. Van Dijk BV gets its regulation from the AFM, and it intends to outsource its operations to the UK branch, primarily because that's where all of the resources, and initially we don't know exactly what the requirements are going to be in Europe. We're aware of some of the regulatory impact, but it's that ongoing process, and we can, if we start from a low base, we can always fill up with people. The other aspect is that Mr. Miller and Mr. Alexander are based in Champion House at Ansfield. They're both directors of Van Dijk BV, and they believe they will save a significant amount of money by doing everything in the UK as much as they can. And I'll allow Mr. Allison to pop over and catch up on things. That is a bit of a tongue-in-cheek as to how things are managed, but it will help to highlight some of those points. From a corporation tax point of view, we have a transfer of business. Where you have a transfer of business, you have a disposal. So you have a gain on this disposal, a third of the business, which is 150 million, which is 50 million. Tax on 50 million is at 9.5, at 19% is 9.5 million. And thankfully, under the EU Mergers Directive, assuming we've done the restructuring correctly, that 9.5 million may be deferred until realization. The same aspect is when you look at it in terms of VAT, and we believe that we've got a business that's going to continue, so we have a transfer of a going concern. And therefore, if you have a transfer of a going concern, no VAT should be applied. The other aspect there is the outsourcing of business between Van Dijk BV and the UK branch, excuse me, and between the UK branch and Alexander and Arnold Limited for the services that are going to be provided in the UK. This is all insurance work, therefore we should have no VAT applied. Another thought is Van Dijk BV with its 2 UK directors and 1 Dutch director. The problem that we have there is, where is that company tax resident? And then we have an ongoing issue which goes going to happen and difficult to predict on 1st of January 2021. We've got employment issues. Where should individuals be taxed? The visas that they need to operate on, and social security issues. Next slide, please. So when we're having a look at this position, we've got exit taxes, and the exit taxes are great, except when we leave the EU, the taxes are no longer covered by the European directives. So we have a problem. The 9.5 million is due and payable, and HMRC very generously, because they're aware of Brexit, have said, why don't you take 6 years to pay it? So you are able to pay it over a 6-year period. All hard. Also, the service agreements, these need to be looked at because one country is getting a tax deduction, the other is going to be taxing the income. Transfer pricing is going to have an impact on this. And also where you're going to end up with profit in which jurisdiction is where you're going to be paying the taxes. You have further issues with regards reporting requirements, DAC 6, which is the mandatory reporting, which has fortunately been deferred from 1st of July of this year, effective through to 2021. So that is very helpful. But there are a couple of other issues that one needs to bear in mind. One is the withholding tax on any interest that's there, and on dividends. Currently, we have a parent subsidiary directive. More or less, in most cases, there is no withholding between a payment from a European company to a UK company. The parent subsidiary directive will fall away because it's a European directive, and we will therefore fall back on what the individual tax agreements are between the UK and, in this case, the Netherlands. One would be looking to see what is covered in that. Do you qualify? And would you get a reduced rate? And not all reduced rates take you down to 0. Some are at 5%, some are at 10%. So again, you need to be careful as to where things are. You don't want to set up a structure, put everything in place, and then pay additional taxes on this on the profit extraction that you have. Can we go to the next slide, please? Right, value-added tax. Value-added taxes, it's like the, my colleagues won't like me for saying this, but it's like the rule book for rugby. It's the same throughout the EU, but everybody has their own interpretation on it, and they apply it in different ways. But generally for financial services, the EU has a much stricter approach to it. And as Chris mentioned, in terms of delegated authority, my goodness, that was never to be seen before. So there is a real problem here in the understanding of the onflow of work with intermediaries. So you have to be very careful, because the outsourcing of a business from one country to another, whilst it may be insurance services, may not be treated as insurance services for VAT purposes. The result is that those services would be subject to VAT, and therefore you're looking at the VAT rates within those individual jurisdictions. So you've got to be very careful as to how you structure the service agreements. You have to look at the service agreements between the UK branch and the UK company to make sure how do you reduce the VAT on that. If they are insurance services, well, then you shouldn't have a VAT charge on it, provided you qualify as insurance services. If they are not insurance services, they will be subject to VAT. What sort of structure? You can have a look at things like a branch registration, a VAT grouping, etc. And just one little bit to mention is the transfer of a going concern on this initial transfer of the business. There are two transfers going concerns you've got to look at. You've got to look at the UK aspect, and you've got to look at the local aspect, in this case in the Netherlands. They have, as I say, different interpretations, and you could end up paying. So you need to be very, very careful on those transfers. The next slide, please. So the key to this in terms of setting up the structure is to actually go back and say, well, what is it that's there? What activity is going to be conducted in the EU country, and therefore what is being transferred to that EU company? You may therefore want to have a look at it and say, are the actions genuinely taking place over there? Is that where the value is? Or is the value still here in the UK, where we are talking to the insurance companies, we're talking to the managing agents? So that means you have a revision to the valuation and a revision to the activities that are taking place in these different areas. As a result of that, you have a revision in your outsourcing agreements, and then you finesse the structure. All bearing in mind that you have this changing market that is taking place, and that we don't know how big a change there's going to be come next year once we've left the EU, in terms of what their interpretation is and how regulation will be applied. We also have an issue regarding company residence. If you remember before, I said that 2 UK directors and 1 Dutch director, and it'd be very nice if Mr. Allison could pop across to Ansfield so that he could catch up on things. Well, if all the mind and management of that company is based in the UK, and your meetings are being held in the UK, very likely that the UK government would say that that Dutch company is now UK tax resident as well. Then you into the scenario of paying tax in the UK and in the Netherlands. You have the double tax agreement. You now end up with trying to get an agreement between the UK authorities and the Dutch authorities over the taxing rights. Other small aspects is the business processing. If you're doing this back branching structure, the systems and processes that you're using have to be sufficient in order for you to satisfy the AFM's requirements in terms of the regulatory requirements. And then thinking about employee mobility, it isn't as simple as just getting on a train and getting off in Brussels or wherever it is that you're traveling in Europe. We will need to be very careful in terms of looking at visas, social security, etc., and number of days in different countries. I think I'll leave it at that point, but it's a very high-level, quick run-through of potentially what's out there and some of the difficulties that are there for you. Just be careful, and it continues to change. And back to Marco.
Thank you, Howard. Yeah, that was you've given a lot of, you threw up a lot of things that that I think the majority of us that run MGA businesses just don't think about, and there's a lot of complexities there, particularly in terms of setting up that I just don't think about, and it was like, oh wow, yeah, I need to look at that. So there's a bunch of questions that actually came up. Just before getting into the questions, if I could ask you guys, is everyone okay for another 10 minutes? So just on that, is there anyone, I know we talked a little bit about other people that are involved, so from the MGA's perspectives that are already setting up and looking at alternatives in Europe, just before we open up for questions that are there, does anyone want to chime in on options that they've explored, other avenues that are being considered, just for the benefit of this group? Just unmute, and then we can talk through that.
Yeah, it's Dan Lotz here. We are a member of the MGAA, but also I'm part of the TISERS group. And we have a particular solution that we have come up with that we believe is a blended model of reverse branching and our own little bit of IP that we're throwing into the mix. We believe that satisfies an awful lot of the tax issues that have just been raised. And thank you very much, Howard. That was incredibly helpful. And I'll probably reach out to you afterwards, just on a one-to-one basis. But if people are interested in our model, I don't want to say too much here because I am quite keen to protect our IP around it. It is fundamentally a reverse branching model, but it does have a little bit of a twist that allows a lot of flexibility within the model in support of the businesses. And again, what I might do is reach out separately to the MGAA to discuss this in the coming weeks.
Okay, thanks, Dan. Anyone else? It's a little TISERS promo there. Fantastic. Anyone else? Any other comments? Otherwise, we'll go to questions. So I'm just keen to hear from our community as to what it is that they're interested in, or things that they've looked at. Okay, so first question that came up was really directed at Chris. Is there a chosen country brokers have set up, and what is the main driver for that selected country? Basically, I think it comes down to, I guess many MGAs are also looking at this to say, when you look at the range of countries that are out there across Europe, are there ones that, apart from where you've already got a footprint that's there, are there ones that are more preferred to others based on all the practicalities, legislation, regulation, tax that would be relevant to the MGA community?
So I think I touched on it a bit in my bit. Was the two most popular are Dublin and Brussels. Dublin mainly proximity language, although people who have gone to Dublin have had some interesting experiences with the Central Bank of Ireland as a regulator, which actually I think is slightly unfair. I think what you'll find with the Central Bank of Ireland is that they understand wholesale broking and they understand MGAs, and so they're alive to the regulatory risks of those models, and so they ask the right sorts of questions. If you go and have conversations with some other EU regulators, as I think we touched on before, they really no idea what's going on. So you can have what seems to be very progressive conversations, and I think people have discovered this in the early days with the FSMA in in Belgium was you would have what seemed to be very encouraging conversations with them, and then they'd go away and think about it and realised what it was that they were said, what they said, and would roll back from it. But in general, people have had good experience in Brussels. FSMA, as I said, the political will was there to be cooperative and to attract new business to Belgium. Obviously, it is quite a volatile political environment in Brussels, and it was very much a Flemish initiative to attract new business to Brussels. And if you got a new Belgian government with a less Flemish balance, then who knows what would happen. So there are risks with everywhere, but yeah, Dublin and Brussels are the two that people where they've chosen rather than where they just happen to have had an office.
Okay. The one of the things, I mean, one of the questions that comes up raises up the whole Malta PCC structure, and there's been no one that's really mentioned that or discussed that. Does the panel have any view on Malta PCC structures as an option, either for wholesale broking or for an MGA business, slightly different, or any experience as such?
So we have some members who have set up in Malta. My guidance to members around Malta is, because it's Malta, which has, it's not a mainstream EU nation, and because of the PCC structure, which it will appear to other regulators as odd, I think you need a good answer to the question why you've set up in Malta. And I think the answer needs to be because I've got quite a lot of Maltese clients, because it was a natural place to go, rather than just the, oh, well, because I think that the regulatory regime was easier to cope with. Because I think there will be moves post-Brexit around the EIOPA table to make sure everyone is maintaining a level playing field. And I think the Malta PCC structure will be one of the ones that people look at closely. So I'm not convinced it's a great solution personally, but that is just personal.
Yeah, I mean, I think from a Lloyd's perspective, I would echo Chris's kind of view on that as well. I think we have had discussions with certain MGAs. I know there's been conversations from the broker side as well, and Lloyd's Brussels is currently taking a view on how its own risk appetite towards PCCs, especially in Malta. But at the moment, I think they're taking a very risk-averse approach, and I think there needs to be a very good reason, a good structure in place in why they're setting up in Malta and why they're choosing to use a PCC rather than a standard MGA or intermediary model.
We're currently involved in the process of helping somebody try and set up it's not a PCC model, but it's more of a divisionalized structure. So it requires a bit more legal aspect around, and for them, there are a number of associations which makes it a lot easier for them to do it. You couldn't do it as independent, fully independent parties, but that's an interesting process as well.
Thanks, Howard. Question for Harris. Has Lloyds considered creating a master cover holder license in the EU where Brussels could delegate back to the UK cover holders?
This is definitely something I've heard crop up numerous times. I think it's definitely been touted as a solution for MGA activity. I think the biggest concern is making sure that there's the appropriate structure and expertise and skills. Obviously, we know that some of the work that the MGAs do can be very diverse and very specific. And it's just making sure that Lloyds and Lloyds Brussels, if they do decide to go down that route, that knowledge and kind of distribution network is maintained and kind of valued the same way that you cover holders and your members currently do it. So I don't think it's something that's been struck off the table, but I don't think it's one that we're actively looking at this moment in time, but it is something that's been suggested previously.
Thanks, Harrison. One last question. I know there's a lot of questions that are there, but I guess we'd only book this for an hour. Last question, and I think we've had this a few times. It's in regards to the reverse branching model, and there seems to be some lack of clarity around it, and several insurers are asking intermediaries to provide a legal opinion on the validity of that model. Does the panel have any comments on that or insight into that?
You could have multiple legal opinions, but the admissibility of the reverse branch model is currently based on an unwritten interpretation by EU regulators of a less than 1 page long recommendation from EIOPA. So it is flimsy legal certainty and the sort of level of legal certainty that no commercial organisation would normally invest this much money on the back of, but it's all that there is. So I would question the value of the legal opinion on given the nature of what the model's based on.
Yeah, and from a Lloyd's perspective, I think we've not specifically asked any MGA or cover holder to provide a legal opinion. I know that when Lloyds Brussels conducted a presentation in February of this year, it was as part of that, and looking at recommendation 9, one of the solutions proposed was a reverse branching model. So it is something that Lloyds Brussels has previously promoted, if that's the right word. And I would say that it's just again you need to be certain about how you're setting that structure up. But something that Howard said, to make sure that you have the appropriate views in regards to employees and tax, all that kind of stuff is in place, and then the appropriate agreements between UK and if you're doing outsourcing or secondments are in place as well. So I think we're not against the idea, but we do like to kind of query it, and we have approved a lot of MGA models that are kind of based on the reverse branch model. So it's something that if coverholders are looking to do, we're for in that sense.
Thanks, Harris. Helen, has there been any discussion about this at the IUA in terms of? I mean, this seems like it's a spot-on topic to for IUA members, because I think I would assume that the questions mainly emanating from IUA risk carriers.
So I can't talk to each individual risk carrier's risk appetite in respect to the reverse branch model. I mean, we have raised this in respect to reverse branching, and it's certainly something that insurers have come across themselves in respect of those that are domiciled in Switzerland and reverse branch under the Solvency II directive into the rest of Europe. And the experience that our members have had is that some regulators are happy with the reverse branch model, others have a lot more questions and aren't necessarily as accepting of it. Whether that reflects the same in the intermediary space is a different matter. We've not actually talked about the specifics of the reverse branch for intermediaries with each individual IUA member company. Okay,
perhaps something that could be tabled there. I think we have to draw.
I'm so sorry on that point. It's also important to remember that within the IDD, it's enshrined within the IDD in Article 6 of the IDD, freedom of establishment. So at this moment in time, there's absolutely nothing wrong at all with the reverse branch option under the freedom of establishments under Article 6 of the IDD, or in and we all are fully familiar with Article 4 of the IDD, which is freedom of services. So this is already in the IDD as it stands, that you can actually have an established branch in another location without a problem at all. And certainly the FCA's support for the model is there with the accommodation around the temporary permissions regime. So you don't need to look too far. Just look at the IDD, look at Article 6.
Thanks, Dan. I think it comes down to legal certainty and whether any, the question which is coming back, which is, are the solicitors prepared to put down a legal opinion on it? And I think that's probably where where it lies. But I'm going to have to draw this to a close. I'd like to thank all my guests for today. I thought that was hugely informative. I think I learned a lot. I'm sure everybody else learned a lot about different aspects. I was hoping that this would be the last Brexit Forum, but I feel it probably won't be. We'll probably have to, as the the situation changes, I think we'll just have to respond to it, and hopefully, at least for the members of the MGA that are looking for solutions, more will come available. With that, I think I'd like to bring this to a close and thank all my guests once again.